Ladies and gentlemen, a very good afternoon to all of you. It gives me immense pleasure to welcome you all to the Citibank Limited's Earnings Disclosure Quarter 2 2022 web event. While scheduling the event, we attempted to choose the most fitting time slot so that we could accommodate the most of the participants, both from local and foreign vicinity and time zones. I am Saida Saima Hussain, your host for the event, welcoming you today. Thank you all very much for joining us. Today we have here amongst us the Honorable Managing Director and Chief Executive Officer of the Citibank Limited, Mr. Mashoor Arifin, Additional Managing Director and Chief Business Officer, Mr. Sheikh Mohammed Maroof, Additional Managing Director and Chief Financial Officer, Mr. Mohammed Mahbubur Rahman, Head of Credit Risk Management and Active Chief Risk Officer, Mr. Misbah Asif Siddiqui, and Head of Internal Control and Compliance, Mr. AKM Saifullah Kausar. As a bank, we take great pride in engaging the investment community in our journey and believe in transparency and accountability in disclosing our performances and actions. The bank's criteria for success have always been not only the bottom line numbers, but also the milestones set towards becoming the most complete bank in Bangladesh. And we have come this far diligently, following the mantra of service and trust with all the support of our community, team, and shareholders. With that in mind, we are gathered here today to present the contemporary financial position and forward-looking strategies of the bank. We shall start with our AMD and CFO, Mr. Mohammed Mahbubur Rahman, presenting the financial performance, followed by our Managing Director and CEO, Mr. Mashoor Arifin, addressing all of you, and finally end with a question and answer session. Before we proceed, I'd like to inform you all that we have opened our question and answer portal, which you can see at the bottom right corner of your screens. You may place any relevant question in the window during our presentation. We shall try our best to address them in our question and answer session, depending on the time available for the program. Ladies and gentlemen, I now request our AMD and CFO, Mr. Mohammed Mahbubur Rahman, to start with the financial performance presentation. Over to you, sir.
Thank you, Saima, and good afternoon. And it's our great pleasure to be in this forum again with our half-yearly financial position and results. So, like before, we'll show you our business performance and the balance sheet position, and also at the same time, we'll actually show the impact on our income statement of this related business and the balance sheet position. The first. We are starting with our loans and advance position. Just let me open the laser. Okay, here you can see that we have actually grown in our loans and advance with 24%. So this is actually, we have managed very high growth in our loans and advance, and we ended the loans and advance with 358 billion taka, and which was 288.3 billion taka at the end of 2021. Though actually our closing actually position actually is showing 24% growth, but on an average actually we grew by 13%. So most of the actually growth actually came at the end of the quarter. So that means actually the benefit of this loan growth will continue for some time, and we are expecting to have higher interest income in the following quarters. So let's see actually what's the impact of this loan growth in our income statement. So if you look at our interest income, actually it grew by 12.9%, almost 13%. So our average book actually grew by 13%, and our interest income actually also grew by 13% and ended with 11.6 billion taka, which was 10.2 billion taka 1 year back. But if you look at our yield on advance, you can see that it's declined a little bit with from 6.78% to 6.72%. But if you remember our first quarter result, when actually our yield was 6.5%. So from there, actually, we have improved our yield on advance, and we are expecting to have actually higher yield for the rest of the area. So here in the second slide, you can see that how actually our loan book is growing over the over last few years from 2018. we are growing constantly, but this year actually in first half of this year, the growth was quite significant. And this high growth within the first half of this year actually will ensure a good return for the rest of the year. But the main strength of this growth is that we are actually continuing our strategy to grow in diversified segment. Here, if you look at the pie chart, here you can see that in 2018, when the corporate book was 60% of the total book, it came down to 50%, even having 30% corporate growth in corporate book. So commercial, so we are actually having growth in corporate, but other segments are growing quite significantly. And our SME, AM, and AS now is contributing 20% of the loan book. And retail and priority is contributing 14%, and also commercial is followed by with 11%. So we are maintaining diversified portfolio. This is one of the strategy. So though at this moment we are having interest rate cap on all segment, but going forward we are expecting to have much better result from these diversified segments. So if you look at the deposit, it also grown by 70% from the end of last year to till the end of first half of this year. It stood at 330.3 billion taka with 17.1% growth. But you all know that our interest rate has increased in the market. Is one of the main reason of this is actually central bank has tied up the FDR rate, 3 month and above FDR rate with the inflation rate. Because of that, actually, the average term deposit rate has increased from 3.5% to 4.3%. So as a result, our overall interest expense has actually increased by 33%. Though actually, it stood at 5.7 billion taka at the end of this half year, which was 4.3 billion taka in the first half of last year. So cost of deposit has increased from 2.64% to 3.07%. So we'll show you how actually we have actually covered this increase of cost from other revenue streams. So if you just there's little bit more actually analysis on the deposit. Here you can see that our deposit is growing consistently also over the last few years, and this year we are having also very high growth in deposit. So it shows the strength of the bank's brand in the market. So we are attracting deposit continuously from all segments. And if you look at the pie chart here, also you can see that our current savings accounts, which was 36% in 2018, has grown to 49%. So it is a huge actual transformation we have made in our deposit book by having more current and savings account, so this is actually one of the core strategies of the bank to actually have more CASA accounts by providing various services and avenues. Our MD will explain more in this regard. So here actually you can see the graph where you can see the movement of yield, cost of deposit, and spread. If you just concentrate on the last part of the graph, then you can see that if you see the quarter-on-quarter movement of this spread, we are successfully maintaining spread till to date. In the first quarter, our spread was 3.6%, and we are still maintaining this spread despite having higher cost of deposit by actually having higher yield on advance. So we are still managing our spread, and we are trying to actually improve it by having a higher yield on advance. So there is still scope to improve the yield on advance. Investment, it has also increased by around 10% from 60.5 billion to 66.9 billion taka. It mostly consists of investment in government securities, and also the return from the government securities has actually also improved. And that's why actually our investment income has also increased by 10% from 1.5 billion taka to 1.7 billion taka. In first half of last year, actually, we had one-off income from capital gain of 450 million taka. So despite not having this one-off income this year, we are maintaining 10% growth in investment income. That means the interest income has actually from government securities, sukuk, and other bonds has actually increased quite a lot. So that's why actually we are still maintaining 10% growth in investment income. Export and import, these are also one of the main strength of this bank. Here you can see that we are still continuing very high growth in export and import business. This year also in first half, we have grown our export business by 27%, 27.5%, from $1 billion to $1.3 billion. Import also has increased by 38.9%. Year on year, from $1.8 billion to $2.5 billion. And because of this, actually, we could maintain our high growth in commission, exchange, and brokerage income, which also grew by 49% from $2.6 billion to $3.8 billion. Despite actually having degrowth in capital market, we all know that there is degrowth in capital market because of fall in share prices. So our subsidiaries, they have degrowth of both subsidiaries have degrowth from 45% to 56% in first half of this year. So but we could actually cover their degrowth in income from our own high growth in export and import business. Card business was a little bit flat at this moment, so there is just little this almost with similar kind of new card active cards we have added in this first half of this year compared to the last half of last year. So last year also we have added 70,500 customer. This year also we have added around 7,400 customer. So we are looking into it to improve how to actually have higher growth in card business. Bill business also, the growth is quite flat actually, with only 1.6% year on year, and reached 21.06 billion taka. So and other operating income, which basically reflects mostly the income from card business, which also remains almost flat with 3.3% growth only year on year, and reach at 1.1 billion taka. So our card base is now around 582,000, and still maintaining the leading position in the market. And though there are some challenges in the market regarding the requirement of having new cards. Earlier, actually, a person having TIN number can have a new card, but now the government has actually changed the regulation. Actually, if someone has to have a new card, he or she must have actually tax return. So that may actually dent the growth of the card business in coming days, but we are hopeful that it will be a short-term impact. So going forward, we'll be able to actually maintain the high growth in card business like before. So altogether, after considering interest income minus interest expense, then commission, exchange and brokerage income, and other operating income, our total revenue actually now stood at 12.5 billion taka with 12% year-on-year growth, which was 11.2 billion taka in the first half of last year. So our revenue, in total revenue, actually grew by 12%. But on the other hand, our operating cost actually has increased by 20% year-on-year, and reached 6.5 billion taka from 5.4 billion taka. With almost 1.1 billion taka growth. So that's why our cost income ratio has actually increased from 48.4% to 52%. We'll explain in the next slide actually why actually operating expense has increased. The operating expense actually mostly consists of a staff cost and the other operating cost. The staff cost actually has increased by 21.7%, reached 3.5 billion taka from 2.9 billion taka. Actually, the main reason actually we are still actually growing our other business segments. For example, the small and microfinance, where actually we have recruited people. We have given actually increments, salary enhancement, which actually contributed for 480 million taka in the and also because of the Bangladesh Bank also imposed minimum salary structure for the employees, and to comply that actually also we have increased the salary of around 2,000 employees, and because of that 120 million taka has increased in first half of this year. And other OPEX has increased by 19% and reached 2.9 billion taka from 2.4 billion taka. And mainly actually because during the COVID period, actually many of the business activities actually were closed, and now actually we are in full operation. And for example, we are having campaigns, card transactions are happening, our airport lounges are open, and we have actually reduced various expenditure in COVID period. Now, under the normal scenario, we are having the normal level of expense. On the other hand, also we invested heavily for improving our IT infrastructure, and we to actually attain our digital banking goal in coming days. So we are investing quite heavily to actually upgrade our IT system. So because of that, is the other operating expense has increased. So, with 12% revenue growth, but around 21% OPEX growth, our operating profit has increased by 4%, 4.1% year on year. So our operating profit is 6.04 billion taka at the end of the first half of this year, which was 5.8 billion taka in the first half of last year. So after operating profit, we deduct out the debt charge or provision, and then tax. Then we get the net profit. So in provision, actually, if you look at the right hand side of this slide, so you can see the provision coverage. We are maintaining provision coverage at the rate of 90%. So still we are maintaining very high provision coverage ratio. Though our NPL has increased from 13.9 billion taka to 15.7 billion taka, but the ratio has declined because our loan book has actually grown actually much higher at much higher rate. Because of that, our NPL ratio has declined from 4.9% to 4%. But if you look at the provision charge, actually the provision charge actually declined by 2.8% year on year, with and we charge 1.29 billion taka in the first half of this year. Actually, despite actually you may ask question that your NPL volume has increased, why actually the provision charge actually decreased? Because actually we had actually a very significant recovery from NPL customer, write-off customer. So because of that, our provision charge actually declined. So it's a good recovery we had in the first half of this year, and we are expecting to have actually more recovery from our return of loan. So that will actually decrease our provision charge and improve our profitability. So before actually looking at this, the net profit after tax of the group, actually let me explain the overall performance of our subsidiaries and Citibank as well. If you look at the last line, you can see that Citibank has grown, profit has grown by 5% from 1.95 billion taka to 2.6 billion taka. So Citibank has managed growth despite having lots of challenge in the market. But Citi Brokerage and our Citibank Capital Resources Limited, which are actually basically dependent on the capital market, because of the capital market scenario, their net profit has declined from for Citi Brokerage declined from 152 million taka to 84 million taka, with 45% degrowth in profitability. Our Citibank Capital Resources, their profit also declined by 42% from 180 million to 105 billion. Our money transfer, they manage is a small exchange house company, not a small, actually it's quite a large small exchange house company in Malaysia, but their profit is in terms of volume is small. So they are growing with 86%, but the impact in the group is less. And Citi Hong Kong is a new company. They have just returned from initial loss to profitability. So it's a good news for us. So Because of this, actually, the degrowth in the profitability of our two subsidiaries out of four, our actually group profitability has declined from 2.3 billion taka to 2.1 billion taka with 5.9% growth. But the bank actually has that's why actually I've shown this slide. Bank has actually grown their profitability, and based on actually the dividend or whatever the return we give to our shareholders actually dependent on the profitability of the bank. But as per the regulation, we have to actually show the group performance in the earning disclosure and also in the share market or our stock exchanges. So with this, actually, our group return on equity, because of decline of the group profit, actually has declined from 15.5% to 13.1% with 7.7% degrowth. Return on asset also declined from 1.1% to 0.9%. Earning per share from 2.2 to 2 taka. So on an annualized basis, we are it's 4.1 taka, but we are hopeful that we'll be able to actually reverse have better situation in the rest of the next part of this year. Book value has increased from 30.6 taka to 30.153 taka. So this is the last slide of our presentation. Here you can see the capital position, our capital adequacy ratio. So with the introduction of 7 billion taka worth of subordinate bond, we have actually improved our capital adequacy ratio from 14.2% to 14.4%. So that means our capacity has increased, though actually the tier 1 capital has declined a little bit, but with the improvement of the profitability, we are hopeful that this tier 1 capital will also improve. On a group basis, the capital adequacy ratios are also increased from 13.4% to 13.8%. So with this, I'd like to actually end my presentation. Thank you all.
Thank you very much, sir, for your enlightening financial performance presentation. Ladies and gentlemen, it is my great pleasure to call upon Mr. Masroor Arifin, Managing Director and CEO of Citibank Limited, to speak about the views and forward-looking strategies of the bank.
Thank you. Thank you, Saima. Thank you, Mabu, for a brilliant presentation of the half-yearly result. And thank you, honorable investors and whoever is listening, seeing us. Thanks all for being here. I will be short. You know that it's a turbulent time in terms of dollar crisis, in terms of high inflation. All these may translate into delay in loan repayment, into our ability going away from opening in terms of opening LCs. So we are going through that tough time. We are hoping that government will look into the interest rate issues. We like or we would want retail interest rates, retail loan interest rates, and small segment lending interest rates to be lifted from 9% as the cost of deposit is growing. That was very clear from Abu's presentation. So last year, June, if you look at 2.6% was the cost of deposit. It has gone up to 3.07% now. Right now it is there. But one good thing about Citibank is that yield on advance has not come down much. So you see, we are more or less at the same position in terms of yield. So we have been successful in keeping our net interest margin above 3.5%. We are managing that well, but we'd like it to go to 4%, which is the regulatory maximum. So now, after a good half year, it could have been worse, to be honest. There are a lot of issues, as inflation rate and fixed deposit rate has been pegged. There was also a liquidity related problem in the market. There is ongoing, COVID related loan repayment holidays going on. And there was these Ukraine war and other global macro situations, and our big portion of the lending book being into RMG, and while there is kind of a depression going in Europe. So all this could have, and also the operating cost going up, all this could have meant that a bad first half. But there lies the beauty of Citibank team that we have actually we have been very careful in all our balance sheet management. We have been very diligent, and that is the reason we succeeded in maintaining a good net interest margin, meaning a spread. We succeeded also in growing current and savings account, which are low cost deposits, which has grew by 49% against about which has grown into 49% of the total deposit book, meaning 50%, which was only, if I remember correctly, was only 35% only 2.5 years ago. So which is good, and our current account and savings account volume has also gone up significantly. It was only a few years ago it was around 70 billion BDT, and now that balance is around 162 billion BDT. So that means that banks' actual focus in the right areas are there. Our CBO, Sheikh Mohammad Maruf, is here present. He's doing a good job. Our CFO is doing a good job. We are one team. We have actually closed central bank's audits recently. So Saifullah Kausar, our head of ICC, is also here doing a good job. Asif Siddiqui, whom you see here, is our acting chief risk officer. We are re-looking at our risk areas. We are now looking at the capital scenario. The book has grown significantly. You have seen that the balance sheet has grown significantly. Balance sheet growth earlier was just a second. Yeah. Balance sheet growth. No, I'll come to the balance sheet little later. Now, little a problem statement is that the cost is growing. The cost has grown. Earlier, it was 48.4% last year's after first half, and this year it is 52%, which basically means something like 100 crore taka, which is like $10 million. So this has happened due to certain regulations which has come in terms of salary and fixing the salary of the lower level employees. So that salary component has cost us around $6 million of cost growth, and non-salaried area cost around $4.5 billion growth. So we are relooking at that. The cost committee is working regularly. Our focus, another good thing is that is there also not only on CASA, it is also there on small and microfinance, which is the bank's number one priority in that area to grow. There has been huge amount of lending. Lending growth has been around 7%. Question may come that when your capital is not so much in surplus above the capital adequacy ratio, why are you growing your book that way? You see, the simple answer is the industry's lending book is growing at much or lower rate. Ours had to grow in a higher rate because we're a large bank. We have a big cost base which is fixed. Plus, also when the spread goes away a little bit, it has actually done away a little bit, because of the increase in cost of deposit. So then you need to play the volume game. So we had to choose this way. So it was a calculated position that we took, but also at the same time, we were growing the budget that we have done for this year. It warranted that we grew in non-funded book, meaning in our LC book also. But now that the dollar crisis there is huge crisis in dollars, and the supply is huge and the demand is much lower than the supply. So now that income we will lose out in the second half. So we need to find new avenues to earn that same, which would have come from commission earning of LCs. Now, another thing is that credit card growth is important for us. In the card area, we have been the market champions, market leaders, but we are seeing that, as opposed to our American Express market positioning, other banks, Visa and MasterCard, they're very aggressive. Competition is very aggressive. Certain competition is doing dumping activity in the merchant acquiring space. So we need to sort those out. Those are very important that, people do not do just balance sheet growth without looking at P&L. So our card is a profitable business. I believe other industry big leaders doing card business will the sense will dawn on them that it's not a volume game or a balance sheet game. End of the day, profitability matters. So they are charging at merchants points much lower than what they are paying to other banks cards coming to those merchants. So but there are aggressive Visa card players, and there are also aggressive Citi Touch copycats, which are our internet banking Citi Touch. We are expecting new Citi Touch to come within next 3 weeks time. It's a new look, new software that is coming. But I'm happy that industry is growing into the digital banking area. Industries other internet banking apps have become popular. So when competition is so hard, it also means that our teams will be more agile and more aggressive. So basically, I mean to say that we need to kind of regain our space. We have lost a little bit in cards and the internet banking, so which is we are very mindful about. And in the card space, the good thing is that NPL ratio is very low as opposed to the total earning that you can have is huge. There is interest rate 20% you can charge, though it's a costly business, but it's a profitable business for the bank. Now I would like to talk about capital. Capital last year was 13.2 solo basis, and this year is 14.0. So if you look at it on solo basis, it has increased. If you look at only tier 1 capital, which doesn't take into account the tier 2 bond of 700 crore we have launched, you will see that on tier 1 side, it was 9.2, and it has rather decreased to 9.5 is now 9.2. Out of the industry's benchmark is Basel benchmark is 8.5. We're above Basel, we're above central bank regulation in both total capital and in both tier 1 and total capital. And the thing is that we had to grow in our book. We had to grow the book, which I explained earlier. So that also means that now we need to be careful that we are little ahead of the minimum benchmark, which is the Basel benchmark for total capital and tier 1 capital. Now, so with IFC, we are working on proper capital planning, which also will include the relooking at the dividend plan. So, and also it will include in terms of relooking at the loan growth and looking at growth in fee income more. So that plan is there, and now I will not continue much. I will simply say that it's been a great first half of the year. I'm very happy that our long-term rating has come to AA1 from AA2 from the Credit Rating Agency of Bangladesh, CRAB, and also short-term rating has also improved from ST2 to ST1. So these basically